Okay, so this video is going to be very quick. We're just going to go through this underwriting tool that we're releasing to the public now. We've had a couple of requests from our underwriting videos to release, just a simple version of underwriting tool that we use. So I'm just going to go through this very quickly. You see here in the version tab, version 0.1, there's a link to the website, Winston Warren, and a link to our YouTube channel where you can, where you're probably watching this video. So when you start looking at this underwriting tool, along the side here, we've got a lot of grouped rows. That's just to keep things clean. And then, so we've got investment details, acquisition cash flows, operating cash flows, disposition cash flows. This is where basically where all the cash flows happen on the deal. And then you have IRR analysis, which is your first analysis, sensitivity analysis, NPV analysis, and then everything down here is additional. So I'm not going to populate this with anything. It's just additional stuff that you can add in. And then out to the right, you have everywhere from year 0, and this will underwrite up to year 30. Okay, so we open up this first one. You can see this is just basic details about the lease that you can fill in. None of these link anywhere else in the document. So these are just details for you to keep track of. Who the tenant is, what the price is, et cetera, right? And just another thing, every blue cell is an input cell, and then the black cells change automatically, right? So you have this purchase price. If you make a purchase price 4 million, that'll change that cap rate a little bit. So on the acquisition side, you have purchase price and you have closing fees. What do you expect to spend on your closing fees? If you change the closing fees here, that'll update this dynamic formula down here in year 0, right? So, right, you can see how this all changes down here, and the closing fee changes automatically. As far as operating cash flow, so this is your year 1 base rent, which for net lease properties is pretty much just NOI. So if I play with this, you can see that that'll change out here. And then if there's any maintenance costs, you can add them in here. And you can see how that populates out. And if there's growth in the maintenance, you can change that here. So here you have your rent, base rent, maintenance costs, and capital reserve. And here you have how those grow over time, right? And see how that changes dynamically. Here is another option when you don't have, sometimes these rent bumps don't happen yearly. They happen like 10% every 5 years or whatever. So you can change here in what year the rent bumps are going to happen. Let's say you had a rent bump in year 3 and it was 10%, right? And so you can see that comes right into play in year 3. In this case, I'm just going to leave those as 0. And then down here in the disposition cash flow, so you could choose what year you want to dispose in. I have year 11. I can put year 16. And you can see how that disposition will go out to year 16. And then I'll leave it on, or year 4. You see it moves there to year 4. I'll leave it on year 11. Here for disposition, you have 4 possible scenarios. You can, modify these however you want. I normally just use 2 scenarios. Scenario 1, I give a 90% probability of happening. Scenario 2, 10%. You can play with these, but it has to add up to 100. If it doesn't add up to 100, you get an error. So just be aware of that. And then scenario 1 is usually tenant renews and you sell at renewal. And scenario 2 is usually an adaptive reuse. You also can use scenario 3, which is tear down and new build, or scenario 4, which can be basically anything you want. But we're just going to stick with looking at these first 2 scenarios for now. So here you have your exit cap rate, selling fees. These are all dynamic. So, if you change the exit cap rate to 6.5, you can see that you're selling at less. If you change your selling fees to 3%, you can see those change, and that's your net proceeds. And then down here is the weighted probabilistic average of the scenarios that you chose. So you can see that this scenario is less than this one, and the weighted average is somewhere in the middle, right? And then here in the tenant adaptive reuse one, you can also see you put in the square footage of the building and you put in a cost per adaptive reuse. This is today's cost. So this automatically assumes a 4% increase in adaptive reuse cost per year. So because this is year 11 and you're putting 25 in here, this becomes 38, right? If I was actually to do this in year 5, you would see that that 25 is only 30, right? So that's all linked up. And you can change this to be whatever you want, and that'll modify there, which modifies here. If you look at the IRR analysis, so IRR analysis, you have the unleveraged cash flows, which you can see graphically here, and you can see going out to the right here, and that'll change when you change the year. And then you have the uh, levered cash flows. So the levered cash flows use these assumptions. So how much of a loan are you getting on this? If you put 0 in here, these cash flows will be identical to the unlevered cash flows, and you can see here that levered and unlevered IRR down here are identical. That's because with 0% we have 0 loan. But if we had, say, 50% loan, you can see how those cash flows change. This shows you, what you're going in with, what you're coming out with on the end, what the cash flows look like over time. And the metrics here are levered and unlevered IRR, as well as levered and unlevered multiple on invested capital. So that's, this in the levered version, you'd be getting back by year 11, 2.15 times what you put in at a, 8.3, nearly 8.3% levered IRR. And you see here, this, these are the cash flows, and those are dynamic. So if I change the year, these will go out further or come back in. The only thing that isn't dynamic that you actually have to manually change here is this chart. So this chart, if I change this year to like year, I don't know, let's say year like 16, you'll see that these cash flows go all the way out to year 16. These cash flows go all the way to year 16, but the charts are still year 11. So if you want to modify the chart to year 16, you just need to come in here and you see it's V, that's year 11. You just move it to AA. So just click here, go AA. I might make this dynamic in a future version, but for now, that's a small modification if you want to see the chart. But the actual cash flows and the returns are dynamic. So they change automatically when you change the disposition year. So don't worry about that. I'm going to move this back to year 11. Right, so you can play with this. And again, if I move that to year 11, then I just have to select data and go back to V. Going down further, you have a sensitivity analysis. I didn't do it on this one, but it's here if you want to do it. This is linked up to the exit cap rate. This is the IRR, levered IRR. And you can, whatever you want to put in here for upside and downside cap rates. And then you can just use the data what if analysis data table function, and that'll give you your sensitivity analysis. Here we have an NPV analysis. So the NPV analysis looks like this. There's 2 sections to it. This first section is used for comparing this asset to corporate bonds. So if you go to ycharts.com, you can get the up-to-date market rate for AA, triple B, double B, and B bonds, and then you can kind of, especially for the publicly listed companies like McDonald's, Starbucks, whatever, you'll know what their credit rating is, so you can compare their cash flows, how much you're getting on for their cash flows versus like a corporate bond. So you should ask for like a small discount, liquidity discount for that, right? So let's say the equivalent bond was trading at like 7.2. Okay, well maybe you want to discount the income cash flows at like 7.8, right? And then maybe the disposition, that's up to you 100%. But if you think it's going to be an easy disposition, like it's very easy to re-tenant the property, or it's very difficult to retain the property, you might want to discount the disposition cash flows at a different rate than you're discounting the income cash flows. I'd say think about the income cash flows as what you're discounting, how you're discounting the lease, and then the disposition cash flows, how you're discounting the real estate itself, right? So let's say we want to do something different here. It's like 8.5. So what you're going to end up getting when you discount those 2 cash flows is you're going to get a suggested NPV of investment, which will give you a suggested purchase price. Suggested purchase price is a little bit lower than the NPV. That just takes into account the fees of purchasing. So essentially what they're saying is you'd want to purchase at this and this cap rate and this price in order to get returns when you discount the cash flows by those rates. And if you come down here, you can look at how that plays out in both levered and unlevered scenarios. If you want to do it unlevered, you just put 0 in here, right? So that's the new scenario with this going in cap rate that you derived from your discount rates. I think this is actually the best way to do this is to figure out what discount rate you want for both the cash flows and the disposition, and see what that comes out as a cap rate, and then use that down here to see what the returns will look like. So if we go in with, let's say, 50% debt, you just play with a few of these numbers. Let's say the loan fees are 1.5% instead of 1. let's say the loan rate is 6, right? Amortization is 25, no interest only period, but you can add that in if you want. Um, right? So this is the return. So the levered return is 9.8% with a basically a 2.4 multiplier on capital, right? And those cash flows are just shown here. Or sorry, those are the loan cash flows shown there. I think the actual cash flows are here. Or they're add together, whatever. This is what it comes out to. And then down here you have room for whatever you want: Monte Carlo analysis, regression analysis. Maybe at some point I'll implement some more of this stuff. If we get enough feedback, people want Monte Carlo analysis, or they want a regression tool in here. Maybe I'll implement that at some point. Here's a chart that I have: maintenance and repair of buildings, how that's changed over time. Here's another chart, looking at comps. Here's another chart looking at comps. This is just stuff that I pull off. I pull off the internet, off various sources, to look at in addition to doing the cash flow underwriting. So basically, when we underwrite these deals, we look at it from two perspectives, right? We look at from the intrinsic value of the cash flows, and we look at it from the fair market value using comparable sales. So you can do both of those here, and you can kind of triangulate on what you think a price is that makes sense. And then based on your situation, if the asset makes sense for you, you can adjust that to figure out what you want to offer. But that's basically it. Really short video. Just wanted to walk through this. Remember that the blue cells are the input cells. If you mess around with the black cells, you probably will break it. So always have a fresh version somewhere, and just use the blue cells for inputs. And that's pretty much it. So thanks a lot. And if you have any questions, always you can head over to winstonwarren.com. Shoot us a message, give us a call, whatever you need to do. We're always here underwriting deals, new deal every week on the YouTube channel. So all kinds of good information there on underwriting these deals. And play with the sheet. Good luck. If you have any questions, hit us up, and we're happy to help.